we will begin with Professor Richard Sylla, Henry Kaufman Professor of the History of Financial Institutions, also Professor of Economics, Entrepreneurship, and Innovation at New York University.
Thank you, Nicholas, and thanks the organizers for this very interesting conference and for including me in it. And I'm very proud to be on a panel with two of my fellow banking historians, who are good friends for a long time. And I've read that what what Beverly Crawford calls their talking points, and I think we're going to have certain similarities of view. In my case, I don't really know that much about Europe, but I think I know a little bit about the U.S. and I can make some contrasts with Europe. And so maybe this, after we get our spiels out of the way, the discussion can really talk about where the European experts can weigh in. All right, into my talking points. I start out by saying, if the United States, could form a, tolerably efficient banking union 200 and some years ago with 13 states, and then, by the time of the Civil War, you have 30 states, and really a lot of these states are at very different levels of economic development. By the eve of World War I, we have 48 states, and then we have a Great Depression. In the middle of the 20th century, we have 50 states. And I would argue that the American banking union was, far from perfect, but it worked pretty well, and it served the United States pretty well. If we could do that in this country, it ought to be a simple thing for what are the 20 or the 17 states of the Euro, or even the 27 or 28 states of the European Union to form a banking union. That's my first point, that if we could do it, Europe shouldn't have any trouble. From the 1780s to the 1860s, this is a similarity between America and Europe. From the 1780s to the 1860s, all the banks were chartered one way or another, either by special acts of legislatures or free banking. He was an expert on free banking, which meant general incorporation laws for banking. The U.S. banking system grew from 3 banks in 1790, I think, to 1,600 or so by the eve of the Civil War. And they were all chartered, with the exceptions of 2 national banks, they were all chartered by state governments. This is a kind of similarity that the early United States had with Europe. I guess all the banks in Europe are creatures of the European states rather than the European Union. Now, despite the multiplicity of state chartering authorities, the American Union, give it a name like the European Union, the American Union managed to achieve a relatively coherent banking system. And I think there are two reasons for that. One is that early in the history of the United States, there were 2 central banks chartered by Congress, first and second banks of the United States. And these banks practiced nationwide banking. The first bank had 9 or 10 branches around the country. The second bank of the United States had 25 branches located all around the United States, and it was operating from 1816 to 1836. And these 2 nationwide branch banks that were the national banks of the American Union, they had regulatory powers over the banking system that consisted of state chartered banks. They got the regulatory powers because they received all of the government's payments, which included a lot of banknotes of the various state banks, and depending, the analysis goes, depending on whether the Bank of the United States thought America needed sort of economic stimulation or it needed restraint, you could achieve this restraint with a central bank from the 1790s to the 1830s by varying the rate at which you returned the notes of the state banks to them. I mean, if Nicholas Biddle thought the U.S. in 1826 was a little bit having a recession, he would return the notes of banks slowly. Usually the U.S. was straining at the bit, and so Nicholas Biddle and other central bankers would return the notes pretty quickly to restrain the state banks from doing too much. Well, this is the problem they had. They restrained perhaps too much, and this was resented both by state bankers and by entrepreneurs and state legislators. And so both of the first central banks disappeared for political reasons, even though they were pretty good economic institutions. Ray Hammond, a famous banking scholar more than half a century ago, argued that the 1832 failure to recharter the second bank of the United States after Congress had passed its recharter was, turned the United States from about the best banking system in the world into one of the worst over the next 30 years. I don't think anybody on the panel would quite agree, go that far with him that it was the worst in the world, but it's fair to say that those of us who studied these early central banks think they were pretty good. And more recently, Mike Bordo, who's sitting right in front of me, wrote a very interesting paper saying that the U.S. should have kept the Bank of the United States model. It might have even been preferable to the Federal Reserve. And so I thought that was a nice thing. Well, the point of comparison with America and Europe is that the European Central Bank seems to me, in principle, it could contribute to a coherent European banking union, just as these banks of the United States did. Now, I mentioned the Fed, but not much. I'll say something about it later on. There's a part of the American banking union that I think is not so commonly known. The second idea, besides the central banks, the second mechanism that gave a certain coherence to this system of, all banks were chartered by states. They could not operate across state lines. How did you get a U.S. banking system? And what happened was, it's sort of one of these spontaneous things that followers of Adam Smith like. The American banks began to keep deposits with other banks across state lines. They did it for a very simple reason. Think of yourself as being in Cincinnati, Ohio in the 1830s or 40s, and you're growing, your city is growing, the people want to have all kinds of goods that come from faraway places. A lot of those goods come into the United States at the port of New York. You have merchants, storekeepers in Cincinnati who want to purchase things as they come off the ships in New York. So why doesn't the bank in Cincinnati keep a deposit in the bank in New York? And then whenever a Cincinnati customer of that bank needs to have New York funds to buy imports, you just draw on the deposit in the bank in New York. That example was repeated, thousands of times around the United States, and we call it the correspondent banking system. No government decreed that it happened. It wasn't really regulated. The bankers of the country just sort of trusted each other and made these interbank deposits. It's going to get sort of after it would develop before the Civil War, the national banking system is going to sort of institutionalize it. Now, it seems to me that European banks, as far as I know, but I'm weak on this, they appear to have correspondent banking relationships within and across the states of Europe, and maybe even across with other parts of the world. But it's my impression that these cross-border, cross-state banking relationships in Europe are not as highly developed as they were in the United States a long time ago. So that could be a difference. If that's true, if the European banking system doesn't have such an elaborate correspondence system, I would like to know why. During the 1860s, we got a little more, we got rid of the national banks in the 1830s. In the 1860s, during the Civil War, we came up with a national banking system and finally a common sort of currency that was issued by or a liability of the federal government. And these national banks were regulated by a national authority, the controller of the currency. There was an intent to get rid of all the state banks as well as their currency issues, but and that was done by passing a prohibitive tax on state bank note issues or even transferring them. But the state banks survive because you don't need to issue notes to be a bank. You can be a deposit bank. So in the United States today, we have a dual banking system where a bunch of national banks and a bunch of state banks. We didn't have a central bank in the period from the Civil War to 1914, but we had substitutes for a central bank. The national banks, the national banking system kind of was a legal recognition or a political recognition of what grew up spontaneously before the Civil War. It said legally a bank out in a town in Ohio, let's say Oxford, Ohio, that would be a country bank. It could hold some of its reserves in a Cincinnati bank, and the Cincinnati bank could hold reserves in a New York bank. And so the system actually encouraged these sort of transfers of money around the United States through the banking system that started earlier with correspondent banking. So the national banks in New York were the ones holding the ultimate reserves. They had to hold 25% reserves in cash, more than any other banks did, and that was a part of a substitute for a central bank. The Treasury Department acted as a substitute for a central bank. Clearinghouses acted as substitutes, and so on. So the U.S., so I'd say in comparison, although the leading banks of the EU can establish offices in states other than the ones of their origin, there's kind of no U.S.-like mechanism whereby the EU can charter banks. That started in this country. Well, it started with the national banks, but then it started with the early U.S. Bank of the U.S. and so on. And then the Civil War brought in nationally chartered banks. Nothing like that seems to exist in the EU now. I wonder whether there's any thought of creating it. Federal Reserve System, that was bringing back the central bank. And then in the 1930s, we had deposit insurance with the FDIC and Glass-Steagall, which was repealed later. It seems to me that in Europe, the European Central Bank has a similar structure to the Fed's, but deposit insurance in Europe obviously is provided by the various countries rather than the European Union. We had an era in American history where the states had their own insurance of deposits. It didn't work very well. It worked much better with the FDIC. We've always had a terribly fragmented banking system in our country. But it was held together by the three central banks, by correspondent banking, by national banks, by deposit insurance. 100 years ago, in the early 20th century, the U.S. had 20 to 30,000 individual banks, and no other country had a banking system quite as crazy as that. 48 state regulatory authorities, several federal authorities. The Fed regulates the comptroller, the FDIC. It's become a little more centralized in terms of its regulation, but it's still fragmented with 7,000 independent banks and some 80,000 branches. But all the relative fragmentation, with all of it, the American banking union seems far more integrated than the European banking union, where individual states still create banks, the only creators of banks, and they're about the only bank regulators. And here's the thing, these privileges of creating banks and regulating banks seem to be jealously guarded by the European states. They were not willing to cede that authority to the European Union. I suggest, I'm about out of time, but I suggested that Europe and America, Michael liked this, Europe and America should pay attention to Canada more, because the Canadians have had a different sort of system, a few big banks, strong federation regulation. It's been a fairly stable system. It might be an oligopoly, but I think it's both the Americans and the Europeans should learn from Canada. It has a stability that might be admired, and we need to understand it more. I know Paul Krugman once said we should go to Canadian-type banking. Yes, it's a cartel, but it's worth it to have banking stability. It seems to me, this gets to Jerry Cohen's remarks that began the conference, that Europe, it's a federation versus a confederation. Europe lacks the central authority to create a more perfect banking union, much less a more perfect political union. And I'll probably close now with a quote from the New York Times recently from David Unger. Maybe some of you read it. It was March 31st, I think. He says, part of Europe's problem, quote, lies in the way the EU was put together in the 1950s and 60s as a loose union of jealously sovereign states, somewhat like the United States under the Articles of Confederation in the 1780s. There are plenty of smart politicians attending EU summit meetings, and plenty of capable European commissioners keeping the Brussels bureaucracy whirring. But there are no Alexander Hamiltons or James Madisons pushing for the interests of Europe as a whole, not just the interests of Germany, France, Finland, Netherlands, or Cyprus, even as ambitious projects like the Euro have increased the need for coherent and consistent rules and policies. Someday, Europe may produce leaders willing to grapple with the task of building sustainable European economic institutions. Until then, the Union seems doomed to lurch from one mismanaged crisis to the next. And it struck me as a fairly good analysis. I tend to be a little pessimistic about the prospects, both for the banking union and the European Union. But I'll pass it off to my more knowledgeable colleagues to continue this.
Thank you very much.